Back in October, we last spoke to Marriott Vacations Worldwide. The vacation rental business spun off by Marriott International 5 years ago. The stock had just gotten slammed down 15%. Wake of a weak quarter where the company was laid low by the super freaking strong dollar. At that time, I said the stock could ultimately become a compelling value play, but I wasn't sure we'd seen the lows yet. Sure enough, Marriott Vacations saw its stock continue to slide down to 46 in late January, but since then it's come roaring back. In fact, the company reported a solid quarter last Thursday, a 6-cent earnings beat off a $1.02 basis, slightly weaker than expected revenue. Plus, Marriott Vacations raised its full-year earnings per share guidance almost entirely because the company retired so many shares with a voracious buyback, but also because they added some new sales incentives. At this point, the stock is giving you a 28% gain since we last spoke to the CEO in October, and it's up nearly 40% year to date. Can it keep climbing? Let's dig deeper with Stephen Weiss. He's the president and CEO of Marriott Vacations Worldwide. Hear more about the quarter and what's next for the company. Mr. Weiss, welcome back to Mad Money.
Thanks, Jim. Thanks for having me back.
Absolutely. Mr. Weiss, last time we spoke, there was just a belief that somehow Airbnb was going to wipe out Marriott Vacations Worldwide. It took the stock down big. When we look at this, it looks like this quarter, we really shouldn't even be putting them in the mix in terms of how Marriott Vacations Worldwide is doing. It has nothing to do with what you do.
Well, we would certainly agree with that. Clearly, Airbnb has a place in the business world, and they're certainly being successful at what they do, but they really don't compete in our space with the type of customer that we have and with the kind of vacation offerings that people are looking for.
Well, one thing is certain. You thought your stock was cheap. You said it on air, and you've bought back a ton of stock. You're very committed to continuing to buy back stock with your excess cash, aren't you?
Yeah, we certainly are. Since we first started buying back stock at the end of the fourth quarter of 2013, we've bought back 27% of our shares, a little over almost $600 million worth of our stock. If you couple that with the dividends that we've been paying, we've returned cash to shareholders in excess of $650 million since that time.
And one of the reasons you're able to do that, you just have very bountiful cash flow. Is that because you have an asset-light model where you just kind of make a lot of money off the interest when people buy timeshares?
Well, clearly we have moved away from a more capital-intensive model, which was essentially one of the knocks that the vacation ownership industry was facing, where, like most real estate development firms, you put a lot of cash out the door up front before you start to get revenues to come in. So now, by partnering with third parties who actually take the development of new properties and put it on their balance sheet, and then we take it out in tranches over time as we need it to fulfill our sales needs, it's a much better profile and a much better return on invested capital.
It also seems that what I should be looking at when I'm trying to value your stock is getting a lot more clear to me. Tour packages matter. How the business is doing intra-quarter matters. It looks like these sales centers will matter much. Washington, New York, San Diego. These are the metrics we should be looking at, correct?
Well, we certainly think so. I mean, if you take the 3 sales centers you mentioned, plus Surfers Paradise in Australia, which we opened in the beginning of April, plus 2 more that will come on between now and the end of the year, one on the Big Island of Hawaii and one in Miami. We think those sales centers alone, once they're stabilized, will generate, call it $125 million of annual sales to add to the portfolio. So every time we add a new resort, we add a new sales center, and with that you get increased revenues because you have new customers.
Now, I know Diamond Resorts got a big bid, which would value your company well in excess of $100. Were you surprised at that lofty price, or is that kind of what you've been saying to people in some way and the market's finally listening?
Well, it's obviously difficult for me to opine on whether or not the valuation that Diamond got is the right one or not. We could simply suggest that we believe that the sector in general has been undervalued, and we believe that the share prices that have been on the vacation ownership stocks have been sufficiently depressed. And obviously, we're happy to see what's happened since our earnings release last Thursday, where the stock's gone up almost 15% just since Thursday.
Now, I know it was difficult on the call to be able to address because it's so speculative, but the Marriott Starwood, it can't hurt you. I know that Starwood has a different organization when it comes to timeshares. It seemed like on the conference call you're basically saying, listen, neutral to positive. Is that how I should view it?
I think that's the best way to characterize it, Jim. We have an exclusivity arrangement with Marriott as it relates to our participation in the Marriott Rewards Frequency Program, the reservation systems, et cetera. In a similar vein, it's my understanding that Vistana Signature Experiences, which was the spin-off name or the sales name of Starwood Vacation Ownership, has a similar relationship with the Starwood organization. Obviously, once that transaction closes, then we'll see how things progress from them. But I believe there's plenty of opportunity for both parties to be able to use as a springboard for future growth.
All right, well, Mr. Hurst, I want to thank you for telling our viewers, look, we think our stock is cheap after it got hammered. That was a fantastic call. You were in there buying what you said you would. Congratulations to Stephen Weiss, President and CEO of Marriott Vacations Worldwide. Good to see you, sir.
Thanks, Jim. Appreciate you having me back.
Absolutely. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.